Hi everyone, welcome back to Be Rich. We've been talking for a long time about this environment where we have high interest rates, and none of us have seen these high kind of interest rates in our living memory because all of us were born or grew up post high interest rates, and we've been living most of our adult life in free, easy money. So Anand always keeps warning us about this, and so I thought today I'll tackle this information on how to deal and invest in this current environment of high interest rates based on what's happened in the past. Historical context of high interest rates. So, period of high interest rates last time was from 1960s to 1990, when the world experienced high interest rates along with high inflation. Unlike today, the debt levels were much lower. That's the biggest difference between now and then, which made high cost of borrowing more manageable for households and businesses. So, the biggest caveat being, yes, there was high interest rate from 1960s to 1990s, but most households and companies and businesses and governments, their debt levels are much lower than what they are right now. We are at a very high levels of debt. So this is a caveat to remember when you look back at the past, especially when you look at hindsight and we're trying to compare what way forward we should think of. Keep this in mind. Past performers in high interest rate environments were in the late 1980s analogy we can look at. And the main analogy is in the late 1980s, it was like the current environment. And there was a huge market crash, which happened in 1987. And despite that crash, almost all the shares rose back above 40% by the year 1990. So in 87, it crashed. And by 3 years' time, most of the shares in the indexes across the globe had come back up by 40%. So that is something to keep in mind. Sectoral performances, let's see, during this time. During this time, the energy sector surged geopolitical tensions because of the oil prices, which seems similar to what we're having today. And healthcare and technology stocks are robust performers, which is also true. We can see similar kind of analogies today also, where the health sector, that's pharma, and technology, which is all our IT companies, they seem to be performing robustly compared to the same kind of scenario way back then. Whereas consumer services and financials were lagging behind the overall market gains, which kind of makes sense. Even now, it's the same problem, which is what's happening when you see the FMCG's companies and you see the financial companies. This is also very true. So, inflation and interest rate dynamics is what we have look at next. And interest rates versus inflation. In the late 1980s, inflation rates were hovering around 6%. Then it dipped to 4% from 86 to 88. Then spiked above 10% in 1990 due to the soaring oil prices. Then interest rates began a period at 11% and ended close to 15%, which is significantly higher than the inflation rate, making borrowing very expensive. We have not raised our interest rates to these levels. Inflation is boiling at a much higher rate than what was boiling at that time. And with oil prices also pushing inflation to high levels of 10%, interest rates were pushed to 15%. That's not happened now. We're still at a very low interest rate when you look at it, comparing those times with this time. That's another thing to look at. So does that leave room for interest rates to go up further is the question. People like Anand do believe interest rates should go up much further to tackle the inflation which we're in. And he feels inflation is going to spike again with wage inflation, which is going to come in next in America. So like Anand was saying, wage inflation is going to come in. And when wage inflation comes in, this is going to push up overall inflations even higher. So he does feel the Fed and the other central banks across the globe will keep pushing interest rates higher, though they seem to have taken a break. And there are people who read the break as a point where it's a turning point and interest rates will start coming down. There are people like Anand who feel interest rates is just a pause. He's just taking a breather. He's giving everyone to adjust to this. Then after which he's going to slowly crank this back up even further to make sure that inflation is very much cooled off. And this also gives the Fed a lot more leeway in case they need to cut rates drastically and dramatically if a full-blown recession sets in. Because right now the American economy is doing robustly, much better than people expected. So it might not be a bad idea to keep interest rates higher or even push them a little further up. So this is something you need to watch. Rates and inflation is something to look at. Challenges for banks in this rising rates environment. What happened? Impact of rising rates. Banks face risks of higher interest rates. That means they could suffer from loan losses due to increased borrowing costs on consumers and businesses. Additionally, investments in bonds and other securities could decline in value, potentially forcing banks to realize losses. We saw this happen in Silicon Valley Bank and other banks also facing this kind of pressure, because what's happened is their old bonds, which they were holding, have lost tremendous value because new bonds are offering much lucrative higher interest rates, making the old bonds of yesterday losing its value in terms of interest rate comparison. So you have to discount if you want to get rid of them and if you need to liquidate them. So this kind of pressure plays out on banks is what we're thinking about when we think of raising interest rates. Examples of vulnerability would be collapse of the Silicon Valley Bank and illustrated the risk devaluing of the debt security. And this situation could become more widespread if the economic conditions worsen. And this is what Charlie and Warren are warning about. There's a potential for a credit event, is what they're talking about. Potential for a credit event is the financial sector risk. There's concern that the rapid growing in bond yields might trigger a financial instability, which is what Charlie spoke about, leading to a credit event similar to what happened in 2008 when financial crisis. The real estate sector in US commercial spaces especially is very, very highly leveraged. There's huge debt sitting there. And all of these debts are going to come calling in the next year or so. And when it comes to this debt, most of them will not be able to be refinanced. And when that happens, we're going to have a catch-22 situation in the US. Then the China real estate risk is there. The Chinese real estate market is presently in the risk. High levels of defaults on loan payments is happening. And after over leveraging in the sector for years and years, people have been warning about this. Analysts have been ringing alarms and bells about this. It's finally coming to fruition now. And we've been seeing huge defaults by very large Chinese real estate companies. We'll have to wait and watch to see what happens here. So what are the current expert opinions and forecasts? Well, inflation expectations, I told you what Anand feels. But other AVR investors anticipate that inflation in major economies will reduce by 2 to 3% by the end of 2024, with the core inflation converging around 2.5%. Anand doesn't feel this and feels maybe inflation, this is a little too optimistic by expecting this level to be there at 2024, because the Israel-Palestine war which is going on, we have no idea what is going to be happening by 2024. Will have reached a peace deal and would things have come to a rest? It's highly doubtful looking at the current scenario, the way things are. And if Iran gets pulled into this conflict, all bets are pretty much off as far as that region is concerned. And with the US also being sucked in, we do not know what's going to happen. So expecting inflation rates to be at this kind of levels seems a little optimistic. So interest rate projections. Central banks are expected to maintain these high interest rates until inflation is firmly under control, like what I said, implying that real interest rates are likely to remain above 2%. This is talking about an average across the globe, not any one specific region. So what are the asset allocation recommendations from the experts? They're suggesting to have an overweight position in equities, if you're especially in the UK and US, Europe and Japan, while be cautious in Asian and Pan-Asian markets, if you're talking about India and the rest of Southeast Asia. Strategic investment approach, government bonds, JP Morgan Asset Management favors UK gilts and European bonds, expecting them to offer better returns compared to other government debts. Corporate bonds, JP Morgan prefers investing in great bonds for adding beta and income to their portfolio, while others are cautious about investment in great bonds but recommend being overweight in US and European high-yield securities. Also asking you to defensive investment strategy, which advocates for defensive mix of investments, anticipating a sustained level of high interest rates, which will impede economic growth. So this is what I want to talk about today, which is what's happening with interest rates and how to tackle the interest rate, which is going to be with us for quite some time, at least for the near future. Thank you for watching the video today, and I hope you found it informative and entertaining, and I'll see you in the next one soon. Bye.
Those who are desirous of meeting me can meet me in Kuwait on the 24th of November, the last Friday of November. After a successful meeting in Hyderabad, my team wanted to do an event in the Gulf again. It has been decided to do it in Kuwait, and hence I am there on the 24th of November, the Friday. Thank you. It's a great privilege and honor that so many of you in thousands have subscribed to my channel and have supported me. I have written two books in English, The Alchemy of Money and Ordinary Stocks, Extraordinary Profits. These books are published by us and are ready. If you want to procure a copy, send us a message to the WhatsApp number given below and my team would respond to you. If you want an Amazon Kindle copy, you can click the link below. Finally, those who wish to consult with me can send a mail to berichenglish@gmail.com. Once again, I thank you for your support. If you like this video, press the subscribe button of my channel, hit the like button and turn on the bell notification.